2. Insurance to protect income. Disability insurance provides financial protection to working individuals who become injured or ill and unable to work. Benefits paid to or on behalf of qualifying insured individuals range from income replacement to paying monthly mortgage, loan, and credit card payments on behalf of the disabled claimant. 2.1 Sources of income protection. There are many sources of disability insurance, DI, coverage available in the marketplace. Anyone who has earned income from employment or self-employment and who is insurable medically may obtain disability income replacement coverage from one or several of the following sources. Black small square personally owned policy, acquired directly from the insurance company. Black small square group insurance coverage, as an employee or as a member of a union or association offering group insurance coverage. Black small square creditor insurance, including mortgage disability insurance, offered to borrowers or credit card holders dealing with major financial institutions. Black small square provincial workers' compensation boards. Black small square disability pensions offered through the Canada or Quebec pension plans. Black small square employment insurance, EI, from the federal government, disability benefits portion. 2.1.1 Individual disability insurance. Individual DI contracts are entered into directly between the applicant, who is also both the insured and the life insured under the contract, and the insurance company. Once the policy is issued, the policyholder is typically the premium payer, the life insured, and the beneficiary under the policy. These policies are usually taken out to replace earned income in the event of disability, but may also have business use purposes, such as insuring against financial loss in the event of the disability of a key employee or of an employer in a small business. Insurance for business use is addressed in Chapter 5. Generally speaking, premiums payable under personally owned, rather than corporately owned, individual DI policies are not deductible for income tax purposes, but then benefits are not a taxable receipt. 2.1.2 Group disability insurance. Group disability insurance is provided to many individuals, plan members, under the umbrella of one group policy. In the case of an employer/employee group plan, the most prevalent type, the employer is the policyholder, and the employee is the life insured and the beneficiary. Group coverage is priced based on the underwriting characteristics of the group as a whole, rather than the individual lives insured. This is explained in more detail later in this chapter. 2.1.3 Creditor insurance. A number of commercial lenders, creditors, offer their clients, borrowers, DI coverage designed to pay scheduled or minimum loan payments in the event that the insured borrower should become disabled and unable to work. The coverage is provided through an affiliated or other third-party insurance company. In the case of an insured traditional loan, the insurance would pay the scheduled monthly loan repayment on behalf of the disabled borrower. In the case of credit card loans, the insurance would pay the minimum monthly required payment for the disabled borrower. These plans typically have at least a 90-day waiting period and a stringent definition of disability. 2.1.3.1 Mortgage disability insurance compared to individual disability insurance, traditional. A specialized subsection of creditor insurance is the mortgage DI market. Mortgage disability insurance is normally provided through the lending institution, the mortgagee, on the life of the borrower, the mortgager, to ensure that the monthly mortgage payment will be made during a time of disability of the borrower. Alternatively, the borrower might take out an individual disability income replacement policy, with the intent of using part of the monthly claim proceeds to make the scheduled mortgage payments. Both approaches have their strengths and weaknesses, as illustrated in Table 2.1. Generally, mortgage disability insurance arranged through the lending institution is less expensive and has less stringent underwriting requirements, but individual disability insurance offers more flexibility to the policyholder, who can use the benefits for other things besides paying the mortgage, for example. Table 2.1 Comparison of mortgage disability insurance and individual disability insurance coverage. 2.2 Individual disability insurance. There are various types of individual DI policies, each defined by the benefits it offers, the factors used to calculate premiums, and the riders that may be added to it in order to customize the coverage offered. 9. 2.2.1 Types of individual policies. One of the ways that personally owned DI policies can be differentiated from each other is by the level of guarantees afforded the policyholder in the contract. These can range from an absolute guarantee that the policy can never be altered or cancelled, or the premium increased during the lifetime of the policy, to contracts that can be cancelled at any time by the insurer. The most common types of contracts are the following: black small square non-cancelable policies, black small square guaranteed renewable policies, black small square cancelable policies, black small square guaranteed issue policies, black small square non-traditional disability insurance plans. 2.2.1.1 Non-cancelable policy. Non-cancelable, non-can policies offer the policyholder the highest level of guarantees. These plans are sometimes referred to as non-cancelable and guaranteed renewable contracts. The rights afforded the policyholder are virtually incontestable for the life of the contract, which is usually to age 65. The policy cannot be cancelled unilaterally by the insurance company. The policy premiums cannot be increased. Policy benefits cannot be reduced or modified. The insurer is compelled to renew the life insured's policy annually until the age of 65. Only the policyholder has the right to modify the policy, subject to underwriting if applicable, prior to its maturity. Once the policyholder turns 65, he typically has the option to convert the policy, without medical evidence, to a guaranteed renewable contract with a shortened benefit period, usually only a year or two. The converted policy will have premiums based on the insured's age at time of conversion, and will typically run to the insured's age 72 or 75. Since the benefit period is reduced to 12 or 24 months, premiums will remain reasonable even if the insured is over 65 years of age. 2.2.1.2 Guaranteed renewable policy. Guaranteed renewable policies bind the insurer to renewing the coverage each year until the maturity date of the policy, usually at age 65, but the insurer has the right to modify premiums unilaterally. The policy of an individual insured cannot be changed. Any alterations must apply to the entire class of policies, impacting all lives insured under that contract type. Any changes to the contract must be communicated to the policyholders, in writing, at least 30 days before a change or cancellation takes effect. The changes are initiated at the time of the annual policy renewal, if at all. 2.2.1.3 Cancelable policy. Cancelable policies offer the fewest guarantees for the policyholder. These policies can be modified. The insurer may change the benefits and premiums based on the claim experience of a given group of insureds or type of insured. The change will apply without the insured's consent, not to just one insured but to all the insureds of that group or type. In fact, the insurer could unilaterally cancel the policy. The only constraint on the insurer is that the policy of just one individual insured cannot be changed. Any alterations must apply to the entire class of policies, impacting all lives insured under that contract type. The contract will require that the insured be advised in writing prior to a policy change or modification, a minimum of 30 days in advance. Because of the lack of long-term certainty afforded the policyholder, all other factors being equal, premiums for cancelable contracts will be lower than those for guaranteed renewable policies, which in turn are lower than those for non-cancelable guaranteed renewable policies. These policies are most often issued to higher-risk occupational classes, such as laborers or taxi drivers, or for insureds who are declined on previous policy types or for those seeking the lowest premium. 2.2.1. For guaranteed issue policy, a few insurers currently offer guaranteed issue DI plans. These plans involve individually issued policies that are an alternative to traditional long-term disability (LTD) group insurance coverage and are available to groups in the low-risk occupational classes of executives and professionals, lawyers, doctors, accountants, etc. These plans guarantee coverage for members of the target group. Because of the guaranteed nature of the plans, they are subject to a number of possible restrictions based on black small square size of the group, black small square occupational class of the group members, black small square minimum annual premium commitment, black small square minimum average age for the group members. The guaranteed issue plans typically carry a higher premium than traditional group insurance coverage, and the insurer generally has the right to terminate the guaranteed aspect of the plan at any time by refusing to accept any further lives insured on a guaranteed basis. Guaranteed issue plans are generally available in two forms: black small square guaranteed standard risk, black small square guaranteed to issue. Both types of plan typically require that the applicants must work a minimum number of hours per week and must be actively at work, not on disability claim, at time of application. Guaranteed standard risk: these plans guarantee not only that they will issue coverage, but that they will issue the policy without any coverage restrictions or premium ratings. There will usually be extra restrictions on the administration of the plan, such as a requirement that 100% of the members of the group in question must participate in the insurance coverage to limit anti-selection, 10, or that 100% of the premiums must be employer paid. Guaranteed to issue. These plans guarantee to issue some form of coverage, but not necessarily exactly the coverage applied for. The insurer generally requires full medical underwriting and reserves the right to apply premium ratings or exclusion riders to accommodate non-standard risks. 2.2.1.5 Non-traditional disability insurance plans. With the advent of the 21st century, Canada has experienced a significant growth in the percentage of workers who define themselves as self-employed contract workers. By 2019, the self-employed represented 15.2% of the Canadian workforce. 11 This is a dramatic shift from the primary market of employees that the disability insurance industry has traditionally served. Changing markets require changing products to serve them. Although many contract workers, who typically receive no benefits from their employers, may be looking for standard disability coverage, others find that sickness coverage is too expensive, or that it requires too long a waiting period to be of practical benefit to someone whose income would stop immediately if they fell ill. Many of these self-employed workers would prefer just an affordable injury, accident policy that would offer first-day benefits. To accommodate this market, some insurers have separated the accident and sickness elements of their DI policies, offering contracts that insure against loss of income due to one cause or the other, but not both. Other adaptations are changing definitions of disability. Some policies have changed the requirement for total disability to the inability to perform specified functions, rather than job duties, since workers who are not employees are offering skills and services, rather than being restricted to specified duties. That is to say, the contract worker is not bound by a job description that defines those things which he is obliged to do for the benefit of an employer duties. Rather, he offers a range of skills, example, marketing, authorship of texts or reports, actuarial consulting, which the principal, his employer, can choose to avail himself or not. Still, other companies are offering an income-based definition of disability, the inability to earn a certain percentage of regular income due to disability, recognizing, again, that job functions may vary from contract to contract. Policies are even now available for the self-employed workers who are unemployed, currently not under contract. The definition of disability then becomes the inability to seek new contracts due to disability arising from injury or illness. And some insurers will even offer limited benefits to those who do not have gainful employment, individuals who provide full-time care to their children at home, perform volunteer services, or are natural caregivers, for example. The policy will provide the insureds with limited monthly benefits, while disabled, to enable them to contract out the services they were previously providing. As self-employment and contract work become more and more the option of choice, or a necessity, for workers in the 21st century, and as workers push the end of their working lives beyond age 65, products will continue to evolve to meet their changing needs. 2.2.2 Individual policy benefits. Disability income replacement policies provide monthly income benefits to lives insured should they meet the definition of disabled under the policy, but the disability landscape is more complex than just that. Disability insurance, DI, policies vary as to the amount of benefit paid, when benefits commence, and for how long benefits might be payable, if they are payable at all in the circumstances. 2.2.2.1 Amount of benefit. One of the risks is that an insured will act differently because insurance is in place. In the case of disability insurance specifically, by being or claiming to be disabled, or to still be disabled, an insured individual could potentially earn an income without having to work. One way of minimizing the risk of this occurring is to ensure that the insured person will not be better off financially while on claim than he was when he was working. Personally owned DI policies normally pay a tax-free disability benefit, allowing for income tax and other benefits normally applicable to income from business or employment. Many insurers will not issue coverage that would pay the disabled life insured more than 60 to 66.66% of their net pre-tax, pre-disability income. Moreover, the benefit will be tax-free. This is a relatively simple calculation when the insured's only source of income is salary or self-employment income. The computation of maximum allowable benefit becomes more complex if the life insured had sources of unearned income that will continue during a period of disability, in addition to his earned income. The way that many insurers deal with this problem is to treat the ongoing, non-earned income source as if it were part of the disability benefit and reduce the coverage offered accordingly. Waiting period. Most DI policies have a waiting period, also often called the elimination period, which is a time frame between the onset of disability and the commencement of benefits under the policy. The primary purpose of a waiting period is to eliminate the need for the insurance companies to Accident and Sickness Insurance Chapter 2 Insurance to Protect Income 23 Process claims of very short duration, which require a significant amount of administrative effort and expense on the part of the insurance company in relation to the insured's lost income and the benefits paid. The waiting period has no effect on the benefit period when the benefit period is less than 65 years. 65 years. 2.2.2.3 Benefit period. The benefit period under a DI policy is the maximum duration for which benefits will be payable. The benefit period starts once the waiting period has expired and benefits run until the insured is well and able to return to work full-time, or the benefit period has expired, whichever comes first. Generally, each instance of disability is treated individually and the full benefit period could apply to each disability. For example, under a policy with a 2-year benefit period, the insured might be disabled more than once over the life of the policy and could claim up to 2 years of benefits for each disability. The most common benefit periods for long-term individual disability income replacement policies are Black small square 2 years, Black small square 5 years, Black small square 10 years, Black small square to age 65. However, as more and more Canadians are working beyond age 65, some insurers offer coverage up to age 75 on an accident-only basis. Short-term disability, STD, insurance policies are more likely to have a benefit period of only 10 to 26 weeks, but this period may be longer in certain cases. The longer the benefit period, the greater the amount of claim the insurer is at risk of paying, and the greater the policy premium will be. 2.2.2. For exclusions and limitations, almost all policies contain provisions for standard, common exclusions, causes of disability for which no benefits will be payable. These exclusions are not specific to the health, vocation or lifestyle of a specific insured, but apply to all persons insured under that type of policy. The most common exclusions include disabilities arising from the following circumstances: Black small square war, whether declared or not, Black small square terrorist acts, Black small square self-inflicted injuries, Black small square attempted suicide, Black small square participating in illegal activities, Black small square normal pregnancy and delivery. The underwriting departments could also limit their exposure to payout if they consider the life to be insured to be an unusual risk by imposing any one, or more, of the following limitations on the coverage applied for: Black small square reduction of the amount of monthly benefit, Black small square reduction of the length of the benefit period, Black small square increase in the length of the waiting period. 2.2.2.5 Denial of benefits. Life and disability insurance companies have a legal obligation to pay valid claims on in-force policies. However, a number of circumstances may arise where a claim is denied and no benefits are paid. Among the reasons for a denial of benefits are black small square misstatement of a material fact on the insurance application, black small square fraud, black small square absence of loss, black small square absence of proof, black small square delay in filing a claim. Misstatement of a material fact on the insurance application. A policy may be voided, declared legally invalid, if, within 2 years of the date of policy issue, it is discovered that the insured made a false statement on the application or failed to disclose information that was material to the underwriting process. This 2-year period is called the contestability period. The rationale for voiding such a contract is the assumption that the policy might never have been put in force in the first place, had the insurance company been in possession of all relevant facts at the time of application. A material misrepresentation is one involving a fact that could have impacted the underwriting decision, such as disclosure of a previous back injury. Fraud. If the misrepresentation was accidental, the applicant forgot about a health factor or honestly thought it not to be important, then no fraud is deemed to have taken place. However, if the applicant purposely misstated information or failed to disclose information with the intent of trying to deceive the insurance company to issue a policy it might otherwise not issue, then a fraud against the insurer has occurred and the insurer has the right to void the policy at any time, even many years after policy issue. Similarly, if the insured commits fraud at time of claim, makes a false claim, the insurer has the right not only to deny the claim, but to cancel the policy. Absence of loss. Benefits are only payable under a disability claim if the claim is proven to be valid, and there is evidence of loss of income as a consequence of the disability. If the insured was unemployed at the time of occurrence of the disability, or was earning considerably less than the amount he had been insured for, benefits might be reduced or denied entirely, in keeping with the actual level of loss, even though the disability itself may be valid. Absence of proof. The disability that is at the heart of the claim must be proven medically. The insurance company will not simply accept the claimant's word that he is disabled and unable to work. The insurer will, at a minimum, request a report from the insured's doctor and may ask for a medical exam or other tests from a physician of its choice. In the case of a prolonged disability, it is usual for the insurer to require periodic medical updates to ensure that the disability actually is persisting. Delay in filing a claim. Lastly, benefits may be denied if a claim is not filed in a timely fashion. Ideally, the insured should contact the insurer within 30 days of the onset of the disabling condition, even if it will be some time before a claim would warrant the payment of benefits because of the waiting period. In any event, a claim must generally be filed within 90 days of the onset of the disabling condition, if practical, but contracts and applicable legislation may vary. The disability insurance policy specifies the timeline during which a claim may be filed, and insurers have the right to decline claims that are not filed by the deadline specified in the policy. 2.2.2.6 Rehabilitation benefit. It is generally in the best interests of all parties involved if a disabled insured can return to work as soon as is safe and practical, best for the insured who will be back to work earning a full salary, best for the insured's employer who will regain the insured's services, and best for the insurance company, who will no longer have to pay the claim. For all of these reasons, the insurer will encourage the disabled insured to take steps to get well and back to work, including receiving physical rehabilitation treatments, medical treatments. Although retraining is not mandatory under DI policies, it is encouraged and will generally be paid for, in whole or in part, by the insurer. The policy may specify a dollar amount that is available to the insured for retraining, provided the insurer accepts the choice of educational program. In some cases, an amount is also included for rehabilitation, medical treatments, subject to insurer approval. The retraining and rehabilitative services for which the insurer will pay include, but are not limited to: black small square physiotherapy treatment, black small square occupational training, retraining, black small square medical treatment, black small square job placement. Black small squares psychotherapy. 2.2.2.7 Benefits for recurring disability. It sometimes happens that an individual who suffers a disabling injury or illness will return to work only to suffer a recurrence of the disability attributable to the same cause. As diagram 2.1 illustrates, if the policy has a fairly lengthy waiting period, the disabled worker could find himself subject to 2 waiting periods, with no benefits, over the course of a relatively short period of time. The recurring or recurrent disability clause found in many DI contracts is designed to prevent subjecting the insured to 2 or more waiting periods without benefits. The insured must qualify on 2 or more instances of suffering a disability attributable to the same cause within a short period of time. Most often a second period of disability that commences within 6 months of the termination of a previous period of disability, due to the same cause, will be treated as one instance of disability, and a second waiting period will not apply, as illustrated in diagram 2.2. The downside to a recurring disability clause can be the fact that the 2 or more periods of recurring disability are treated as one for purposes of calculating the benefit period. Particularly if the benefit period is relatively short, 2 to 5 years for example, this could significantly impact the total amount of benefits received due to a prolonged disability. Diagram 2.3 illustrates how benefits could run out before the end of the second disability period. WP refers to the waiting period. 2.2.2.8 Benefits for presumptive disability. Presumptive disability occurs when an insured suffers certain specified injuries or conditions which are deemed to be so severe that the person is presumed to be disabled, even if the disability does not result in a loss of earnings. The types of injury/condition are set out in the policy and would typically include black small square total and permanent loss of hearing, black small square total and irreversible blindness, black small square loss of or loss of use of both arms or both legs or one arm and one leg, black small square total and permanent loss of speech. In such instances, the normal waiting period under the policy is waived, benefits start immediately, and full total disability benefits are payable for the life of the benefit period, even if the insured is able to return to work full-time and even if he can now fulfill all of the duties of his previous employment at full salary. To qualify for presumptive disability benefits, unlike the case for most definitions of disability, the insured does not have to prove a loss of income due to the disability, only that the qualifying disability exists. Presumptive disability is a benefit offered in most but not necessarily all policies. Example: 2.2.2.9 Survivor benefits. Some disability policies offer a survivor benefit, payable to the insured's estate, should the insured die while on disability claim. In some instances, the policy requires a qualification period, such that a survivor benefit is only payable provided the insured had been disabled for a minimum period prior to his death, such as 12 months. The benefit is paid out in a lump sum, upon proof of death, and is usually equal to 3 times the monthly total disability benefit. Example: if the monthly benefit was $3,000, the survivor benefit would be a lump sum of $9,000. 2.2.3 Individual policy premium factors. Aside from the amount of monthly benefit requested, there is a wide range of factors that are taken into consideration in setting premiums for a disability income replacement policy, such as black small square age of the insured, black small square gender of the insured, black small square health of the insured, black small square smoker or non-smoker status, black small square occupation, black small square definition of disability used, black small square claims history of the insured, black small square length of waiting and benefit periods for the policy. These factors will be examined in the following pages, and their impact on disability insurance (DI) premiums discussed. Other factors not related to a specific life insured are also taken into consideration in setting premiums, namely an estimate of investment returns on accumulated premiums and general operating expenses. Most importantly, morbidity tables 12 must be taken into consideration in assessing and pricing the potential cost of taking on risk. These factors will be addressed later on in the manual. 2.3.1 Impact of gender and age. As with life insurance, both the gender and the age of the life insured under a DI policy are two of the most influential factors in setting policy premiums. In the case of gender, insurance companies' disability claims history illustrates that the number and length of claims is higher for women than men. Although the likelihood of disability occurring decreases with the age of the life insured, the duration of a disability claim generally increases with age. Table 2.2 illustrates the risk of becoming 12. Morbidity is the actuarial estimate of the risk of disability within segments of the population, broken down by age, gender, occupation, etc. Totally disabled prior to age 65 for more than 90 days, and the average duration of the disability. It is a sample table only. Insurance carriers compile their own morbidity tables based on their claims experience with their target markets. Already reached 45. However, the average duration of the disability is longer among those in the second group. Consequently, women are likely to pay higher DI premiums than males of the same age for the same coverage, and older applicants will likely be faced with higher premiums than young ones. 2.2.3.2 Health issues. The past or present health of a disability insurance applicant is a critical factor in the underwriting process. Standard premiums and benefits are based on the assumption that the applicant is a standard life, likely to face the same risks of disability as the average individual. If the applicant has had health issues in the past, or is currently ill or injured, he may be uninsurable, or would at least be subject to premium ratings or exclusion of coverage for specified causes of disability. For example, if the applicant consulted a healthcare specialist within 1 year prior to the application, the condition that led to that claim could be classified as a pre-existing condition. Insurers will usually issue DI policies with a 1-year exclusion rider from the date of policy issue for claims relating to a pre-existing condition. Even the health of parents, grandparents, or siblings may come into the underwriting process if the applicant's family members suffered from conditions that are inherited or are likely to run in families, where, for instance, more than one family member may have had cardiovascular disease or breast cancer. Insurers gather relevant medical and health information on prospective insureds from a variety of sources: black small square non-medical form on the application, black small square attending physician's statements, APS, from the applicant's doctor, black small square paramedical exam from a nurse, if required, black small square full doctor's medical exam, if required, black small square blood, saliva and urine samples, black small square data from the Medical Information Bureau, MIB, black small square inspection report from an investigator for lifestyle issue. 2.2.3.3 Definitions of disability. The definition of when an insured is disabled for purposes of disability insurance is not just a single one. Disability can be measured as partial or total, and within that range there are 4 distinct definitions that are employed by different policies: black small square own occupation, black small square regular occupation, black small square any occupation, black small square total disability, according to the CPP. With the exception of workers' compensation coverage, which deals exclusively with work-related injuries and illnesses, the cause of disability is generally not considered. Partial disability will be defined later in this chapter. Own occupation. The own occupation definition of disability is the most liberal in that it is the easiest under which to qualify as being disabled. With this definition, the insured is considered to be totally disabled if he cannot perform all of the primary duties of his regular occupation, even part of the time. There is no requirement that he return to work, either in his previous role or some other suitable role, until and unless he can perform all the primary duties of his regular occupation. While he meets the definition of disabled under own occupation, benefits will be paid, even if the insured works in a different occupation. Surgeon, he continues to receive benefits under his DI policy, which has an own occupation definition of disability. Because of the generous benefits under an own occupation definition of disability, its availability is generally restricted to the highest classification of occupations, those which are least likely to need to file claims, and it can be the most expensive product from a premium perspective. What makes own occupation expensive is the larger policy purchased by high-income professionals who qualify for a cheaper rate $100. They are least likely to need to file claims and tend not to stay on claim as long as other occupation classes, i.e., if two policies were issued for the same amount of coverage, example, $3,000 per month, the own occupation policy of high-income professionals would be less expensive than the any occupation policy of other lower occupation classes. Regular occupation. Regular occupation uses essentially the same definition and has the same implications as own occupation, but with one difference. If the disabled insured elects to go back to work in any capacity, benefits from the policy will be reduced and could, in fact, be terminated. However, the insured is not compelled to return to any occupation, even if physically able. The choice is left strictly up to the insured. Compared to the own occupation definition of disability, regular occupation definition of disability, which is generally intended for the highest classification of occupations, such as doctors, dentists, lawyers, etc., may be offered to almost all occupational classes. Dentists, lawyers, etc., may be offered to almost all occupational classes. Any occupation. The any occupation definition of disability is the easiest under which to qualify for coverage, but the most stringent under which to file a claim, since the insured's ability to perform the duties of any suitable obligation disqualifies him from being classified as disabled. The any occupation definition is, therefore, available to the most insured individuals, particularly those in the higher risk occupational classes. The insured will be considered to be disabled if he is ill or injured, unable to perform some or all of the functions of his regular occupation, and is not able to perform the functions of any other occupation for which he is suited by education or experience. In effect, an insured who is disabled and unable to function in his regular occupation will be expected, within a reasonable period of time, to become reemployed in an alternative occupation suited to the insured's level of education or occupation, if possible, or else his insurance benefits will be terminated. Total disability according to the Canada Pension Plan, CPP. Total disability is essentially the definition used by the Canada Pension Plan, CPP. Point 13. The inability to perform the functions of any occupation for which the insured is suited by education and experience. It also entails that the insured will likely never recover and be able to return to employment, and in fact, will likely eventually die from the cause of the disability. Such a drastic definition is seldom employed by individual or conventional group DI policies, but may be found more often in creditor insurance coverage. 2.2.3. For occupational clause. In underwriting disability insurance, the occupation of an applicant has a significant impact on black small square whether the applicant is insurable. Black small square the type of policy available. Black small square the riders and benefits available. Black small square the cost, premium level, for the coverage. Certain occupations are inherently more susceptible to injury or stress than others and are therefore more prone to claims. In order to codify the risks that insurers are willing to assume, occupations are generally divided into occupational classes. Although different insurers use different methods of classification, the following is the most common. 4A. Professionals, such as doctors, lawyers, dentists, and senior executives. 3A. Administrative office workers who face few, if any, workplace hazards, such as clerical staff. 2A. Supervisors in low-risk environments, salespersons and like occupations. A. Skilled manual workers who face few or no workplace hazards, or those working, for instance, as courier truck drivers. B. Manual laborers who work in hazardous environments, such as home construction workers. Aside from the simple issue of price, a 3A occupation would command a higher premium than a 4A occupation for the same coverage. There may be certain policy types or benefits not available to those in higher risk classifications. For example, an applicant in the 2A class would not usually qualify to acquire own occupation coverage or a non-cancelable contract. Because occupational class plays such a critical role in risk assessment and policy pricing, most DI contracts have an occupational clause that specifies that the insurance company has the right to increase premiums or adjust benefits if the insured changes occupations to one in a higher risk classification during the term of the policy. On the other hand, the insured also usually has the option to request a reassignment to a higher classification and a premium adjustment in his favor should he change jobs from a lower classification occupation to a higher classification one. At the underwriting stage, the insured could also be eligible for an occupational class upgrade if he fits the right parameters, such as staying with a job or holding a certain income for a certain length of time. An upgrade would translate into a lower premium even though the insured remains in a higher risk occupation. Such reassignment would, of course, be subject to medical underwriting to ensure that the insured hadn't developed into a higher risk for reasons other than occupation. 2.2.3.5 Waiver of Premium. For DI policies, waiver of premium is not a rider, as it is with life insurance policies, but is an intrinsic provision of the contract for which no additional premium is charged. The waiver provisions waive the policyholder's obligation to pay premiums during the time that the life insured under the policy is on disability claim. Typically, the premium must be paid by the policyholder during the first 90 days of claim, and then the waiver commences. Many policies will refund the premium paid during the 90-day waiting period. The premium will be waived for the duration of the disability claim, or for a period of anywhere from 2 to 5 years, to the end of the benefit period, or even to the life insured's age 65, whichever comes first. Depending on the terms of the contract, waiver of premium may apply only to claims involving total disability, or to instances of partial disability as well. 2.2 For riders to address needs. Disability insurance is not a one-size-fits-all proposition. As noted above, there are standard provisions inherent in almost all disability insurance (DI) policies, but the circumstances of individual lives insured may require special benefits or restrictions. The insurance industry accommodates these special circumstances by adding riders to policies, special provisions that are unique to that policy. 2.2.4.1 Concept of customization. Customizing means modifying the terms and conditions of a standard DI policy by adding riders to the contract, special clauses that add, remove or restrict benefits in accordance with the needs of the applicant for protection, or the wishes of the insurance company to limit its exposure to risk. A number of the more common riders are described in some detail below. 2.2.4.2 Differences between equivalent riders. In reviewing a policy or recommending the purchase of a new policy, it is important to carefully consider the exact details of definitions or riders. There are standard definitions within the industry, but that does not mean that each contract or each rider adheres strictly to the standard. One cannot simply assume that a given rider will offer standard benefits. The rider text must be carefully scrutinized, or competing riders compared, to ensure that the riders in question are in fact equivalent. 2.2.4.3 Future Purchase Option, FPO. The Future Purchase Option, FPO, also sometimes called the Guaranteed Insurability Benefit, GIB, or Guaranteed Insurability Option, GIO, on a disability income replacement policy serves the same purpose as a GIB on a life insurance contract, guaranteeing the insured the right to purchase additional coverage in the future, regardless of future changes in the life insured's health. Traditionally, options to increase coverage were offered every 2 years or so. Policies issued more recently offer the options on each policy anniversary. Assuming that the underlying policy was issued at standard premium rates, any new coverage subscribed for under the FPO would also be issued standard based on the life insured's attained age 14 at the time the option is exercised. Options are usually available up to the life insured's age 50 or 55, depending on the contract. There will always be a maximum limit to the amount of coverage that can be purchased under the FPO, both on how much coverage can be purchased per option and how much can be purchased overall. The per option limit is often based on 20% of the base coverage, to a maximum of $1,500 a month of new coverage. The overall limit is typically in the range of 2 to 5 times the initial amount of coverage under the base policy. New coverage acquired under the option will be based on the same occupational class as the original policy, provided the insured has not changed occupations. If the life insured is on disability claim at the time the option arises, the contract may permit the FPO to be exercised immediately, or the exercise may be delayed until the termination of the current claim. The key restriction to exercising the FPO is that the insured must qualify for the additional coverage financially. As noted earlier in this chapter, the amount of disability income replacement insurance for which an individual can qualify is restricted to about 60% of his pre-disability earned income. This same limit applies to the exercise of an FPO option. If the coverage currently in force is equal to 60% of earned income, no further coverage can be purchased, even though the right to purchase coverage without medical evidence is guaranteed. Two rules apply. Black small square if the insured's current income has not changed since policy issue or exercise of the last option, and the coverage currently in force equals 60% of current income, the current option may not be exercised. Black small square if the insured's current income is such that 60% is greater than the current coverage in force, the current option may be exercised, to a maximum of the current option, or an amount that would bring the coverage up to 60% of current income, whichever is less. Allows for up to $600 a month of coverage without medical underwriting. In order to exercise an FPO option, the insured must provide the insurer with proof of current income. Also, exercising the FPO would add additional coverage, resulting in a corresponding increase in premium. 2.2. For cost of living adjustment, COLA. One of the problems faced by insureds living off the benefits of a long-term disability, LTD, claim is that the cost of goods and services, cost of living, that the disability benefits are intended to provide for are constantly rising with inflation, while the disability benefit may be fixed. A cost of living adjustment, COLA, rider provides for an annual increase in the monthly benefits being paid under a disability income replacement contract, starting the second year that benefits are paid. The benefit is payable by one of two methods. Simple, the benefit is indexed by a flat rate, 2.00 or 4%, for example, based on the initial benefit payable. Compound, after the first year of claim, the benefit is indexed to the rate of inflation, on a compound basis, 15 usually based on the inflation rate for the previous calendar year. The indexing is based on the Consumer Price Index, CPI. There may be a maximum indexing rate for any 1 year, 5% perhaps, but many policies allow for a carry-forward of unused indexing. For example, if the indexing rate for year 4 of claim is 1.5% lower than the maximum allowed under the contract, that 1.5% can be carried forward to future years, to create more indexing room for years when the inflation rate exceeds the maximum annual indexing permitted under the contract. On the other hand, the maximum amount of indexing is capped at a predetermined limit, such that the annual benefit ultimately paid out under an indexed policy might not be able to exceed 2 or 3 times the initial, unindexed, annual benefit. Some DI policies offer an alternative to COLA, called an automatic coverage enhancement, or automatic benefit increase, which automatically increases the benefit by a small set amount, 2 or 3%, without underwriting, medical or financial, but with a corresponding increase in premium. The option is subject to review, and possibly later underwriting, on a periodic basis, such as every 5 years. The automatic enhancement is offered instead of, rather than in addition to, 2. COLA. The benefit provides an indexed policy with increasing premiums that applies the increase in coverage after the policy is issued, and does not wait for a claim to be made. It basically attempts to keep up with annual raises that most employees receive. 2.2. For 5. Accidental death and dismemberment, AD&D. The accidental death and dismemberment, AD&D, rider provides additional benefits, over and above those benefits payable on account of income loss due to disability, should the life insured incur death or specified severe injuries due to an accident. For a claim to be receivable, the death or loss must occur within 365 days of the accident in question, and the death/loss must be directly attributable to the accident. Typically, a specified lump sum benefit, referred to as the principal sum, will be paid in the event of death, and lesser benefits, a percentage of the principal sum, would be payable for the loss of or loss of use of sight, hearing, or one or more limbs, etc. Because benefits are only payable in the event of accidental loss, no medical underwriting is required at time of issue of the rider. This is not to be confused with the survivor benefit, discussed later in this chapter, for which there are different criteria for filing a claim in the event of death. Standard exclusions apply, like loss or death due to black small square self-inflicted wounds, black small square attempted suicide, black small square participation in dangerous sports, black small square flying other than as a passenger on a commercial airliner. 2.2.4.6 Partial and residual disability benefits. If disability insurance were an all-or-nothing proposition, where you got full benefits if you were totally disabled, but no benefits at all if you were to return to work part-time, it would be very difficult to encourage a disabled worker to return to work part-time. Difficult to encourage a disabled worker to return to work part-time. Residual disability benefits. As an incentive for disabled workers to return to work as soon as possible, many DI policies offer a residual disability benefit, one that will pay the disabled a portion of his benefits if he is able to work part-time following a period of total disability. In order to qualify for the benefit, the insured must first meet specified criteria, usually a minimum period of total disability under the contract, often 6 months, including the waiting period. If the disabled worker is then able to return to work and perform some of the substantial duties of his job, or all of the substantial duties, but only for part of the time, he will have 2 sources of income, part of his employment income and part of his disability benefits. There are minimum and maximum income requirements for an insured to qualify for residual benefits. There must be at least a 20% reduction in his pre-disability income before he can qualify for benefits. Or expressed another way, if he can earn 80% or more of his pre-disability income, he will not qualify for any benefits. On the other hand, if the insured can only earn 20% or less of his pre-disability income, he will qualify for full benefits. Earnings between 20% and 80% of pre-disability income will result in a pro rata benefit, proportional to the percentage of income lost to disability. Partial disability benefits. Some insurance contracts will pay a partial disability benefit from the outset of disability, not requiring a period of total disability. If the insured is unable to perform some of the substantial duties of his job, or is able to perform all of the substantial duties, but only for part of the time, he would receive 50% of the total disability benefit for a period of 2 to 3 years, considered the partial disability benefit, or the residual disability benefit, whichever is greater. Some DI contracts require a qualification period of total disability before partial disability benefits will be paid, and all contracts require that the insured be under a physician's care. 2.2.4.7 Return of Premium, ROP. A common concern with disability insurance, as with most types of insurance, is that the policyholder may pay thousands, or tens of thousands, of dollars in premiums over time, but if no valid claim is ever filed, never receive any benefit for the premiums paid. The Return of Premium, ROP, rider addresses this concern. Typically, the rider provides for a tax-free return refund of premiums paid if the policy expires at the life insured's age 65, for example, and the total claims paid over the life of the policy do not exceed the total premiums paid. For example, black small square if there are no claims by age 65, when the coverage expires, 70% of all premiums paid are repaid to the policyholder. Black small square if claims are filed during the life of the policy, but the total of benefits paid out is less than the total of premiums paid in, the difference would be paid to the policyholder when the coverage expires. Black small square if the total of benefits paid out over the life of the policy exceeds the total of premiums paid in, no return of premiums is payable. Some policies provide that if a policy is cancelled prior to its maturity date, with no claims having been filed, a partial ROP is paid. Other policies provide that, if the contract goes for a specified period, typically 8 or 10 years, without a claim having been filed, anywhere from 4 times the annual premium to 70 to 80% of the premiums paid during that period, or a proportion of the annual premium will be returned to the policyholder. The rider is expensive, however, often adding 40 to 60% to the cost of the base DI premium. 2.2. For .8 ratings and exclusion riders. If an applicant for disability insurance has health or lifestyle issues that result in his being assessed as a higher risk than standard, the underwriting department has 3 options for dealing with the application. Black small square decline to issue the policy. Black small square impose a premium rating. Black small square add an exclusion rider to the policy. A decline is usually the option of last resort. It means that the policy is not issued. Premium rating can be used to assume risks that are substandard, but not so high a risk as to be uninsurable. This is particularly true where the applicant has an overall health issue, like diabetes or hypertension, which could impact the applicant's general health or ability to function. The increased premium, the premium rating, compensates the insurance company for the increased risk that it is willing to assume. If the condition in question is controlled with treatment in the future, the insured may have the option to be re-underwritten medically and have the rating lowered or removed once the condition is under control. In some cases, the circumstances that make the life to be insured a substandard risk might be a specific lifestyle or vocational activity or a specific condition that is more likely to trigger a period of disability. In such cases, the insurance company might issue the policy, but with an exclusion rider that specifies that no benefits will be payable on account of a disability arising from the identified activity or condition. In instances where an exclusion rider has been added to a DI policy, it is typical for the contract to be issued with a standard premium, and for it to cover episodes of disability resulting from any other standard cause not covered by the rider. 2.2. For .9 Hospitalization benefit. Basic disability income protection insurance provides benefits to replace earned income lost during a period of disability, but does not provide additional cash flow to cover extra expenses incurred as a consequence of that disability. For example, if the injury or illness that caused the disability results in the life insured having to spend time in the hospital, extra expenses may be incurred. Special riders may be added to a DI policy to cover those expenses. One such rider is the first-day hospitalization rider. Hospitalization costs may arise long before any benefits become payable during the waiting period under the base policy. The first-day hospitalization rider is designed to bridge the gap between the first day of hospitalization and the first day that disability benefits begin, often 90 days later. The rider has no waiting period, but typically requires a minimum hospital stay of from 24 to 72 hours for benefits to be payable. The benefits involved are a daily pro rata of the monthly disability benefit under the base policy. The hospital indemnity rider provides a daily benefit, usually between $50 and $250 a day, to cover specific expenses incurred as a consequence of hospitalization. It might, for example, cover child care expenses for a spouse visiting a hospitalized spouse on a regular basis over a prolonged period of hospitalization, or parking costs at the hospital, which can be substantial for that same visiting spouse. It is typically a first-day benefit, providing the hospitalized individual has a stay of at least 24 hours and may provide benefits for 3 or 4 months maximum. 2.2.5 Taxation of Individual Disability Insurance (DI) benefits. The amount of disability insurance for which an applicant can qualify will, in part, be impacted by whether or not any benefits would be received as taxable income or tax-free, since tax-free benefits would obviously represent a higher proportion of the insured's pre-disability, after-tax income. In a similar vein, whether or not premiums paid for disability insurance can be deducted for income tax purposes could have a significant impact on the affordability of the coverage. 2.2.5.1 Tax treatment of premiums and benefits. Generally speaking, premiums paid for individual disability income replacement policies are not deductible for income tax purposes, and benefits received do not have to be included in taxable income. This is the case for disability benefits, treatments paid for by the insurer on behalf of the insured, and waiver or return of premium (ROP) benefits. This remains true almost regardless of the purpose for which the policy was purchased. For example, a key person DI policy taken out on the life of an employee of a sole proprietorship falls into the category, so long as the employer pays the policy premiums and is beneficiary of the contract. The policy premiums may be a valid business expense, but they are not a tax-deductible expense, and the benefits are non-taxable. There are some exceptions to these rules, such as business overhead expense, BOE, insurance, that are covered in detail in Chapter 5. Individual DI policies taken out by an employer on a class of employees on a grouped basis are subject to different tax rules, but again, these are outlined in some detail in Chapter 5. If a DI policy is taken out by an unincorporated employer on the life of an employee and the benefits are payable to the employee, then the premiums will likely be tax-deductible by the employer and the benefits will be taxable for the employee. In addition, either the premiums paid by the employer or the benefits received by the employee, but not both, will be treated as taxable income in the hands of the employee. 2.2.5.2 Taxation differences between personally owned and corporately owned disability insurance (DI) policies. Many of the same rules apply to corporately owned DI policies as personally owned DI policies. Disability insurance purchased to protect the corporation's financial interests in the event of the long-term disability of a key employee, or to buy out the interest of a permanently disabled shareholder, is treated the same as a personally owned DI policy. The premiums paid are not tax-deductible, nor are benefits received by the corporation a taxable inclusion. Tax-deductible, nor are benefits received by the corporation a taxable inclusion. If a corporately owned DI policy is ensuring an employee's ability to work and the employee is the beneficiary of any policy benefits, the premiums paid will be a deductible business expense for the employer but a taxable benefit for the employee for the year in which they are paid. On the other hand, if the life insured under a corporately owned policy is a shareholder of the company, or both an employee and a shareholder, the Canada Revenue Agency, CRA, is likely to rule the premiums paid to be a shareholder benefit, non-deductible by the employer but taxable in the hands of the shareholder. 2.2.6 Conversion of policy. Conversion is a provision most commonly associated with life insurance policies, the right to convert a term life insurance policy into a permanent life policy with the same insurer, without having to provide medical proof of insurability. Or to convert group life insurance to individual life insurance of the same nature. The group insurance coverages are also convertible to individual insurance coverages without proof of insurability. Furthermore, buy-sell insurance policies and BOE insurance policies also contain a conversion clause. In instances where the coverage is no longer required for business purposes, the business has been disbanded, or the life insured is no longer an employee or co-owner of the business, the conversion privilege will permit the life insured to transfer the policy and coverage into his own name, without medical underwriting, such that the policy is now personally owned individual DI. Coverage. At the time of conversion, the insurance company may not re-underwrite the coverage financially to redetermine if the insured can qualify for the face amount. That decision would have to be made at time of claim. As noted early in this chapter, many non-cancelable DI policies also offer the policyholder the option to convert the contract to a guaranteed renewable policy at age 65, with a limited duration and benefit period. 2.3 Group Disability Insurance. Group disability insurance is provided to many individuals under the umbrella of one master policy. With employer/employee group plans, which will be the primary focus of this section, the employer is the policyholder, and the employee is the life insured and the beneficiary. Group plans offer cost-efficient coverage with little or no administrative effort on the part of the insured. For that reason, many people have primarily, or only, group coverage in their portfolio. 2.3.1 Providers of Group Disability Insurance. Because group disability insurance, DI, coverage is usually offered to the members of the group without medical underwriting, it is important to the issuing insurance company that the group members have some element of commonality, so that their risk can be pre-assessed based on criteria other than actuarial tables. For that reason, group insurance is not just offered to anyone who wishes to take advantage of it, but to potential lives insured who exhibit some common traits such as black small square work for the same employer, black small square work in the same industry, black small square are members of the same association, black small square are alumni of the same university, black small square belong to the same union, etc. The common factor offers the insurer at least two advantages: the opportunity to underwrite based on shared characteristics and risks, and a central organization of some sort to administer the plan, enroll members, collect premiums, etc. 2.3.1.1 Employer. Employer/employee groups are by far the most prevalent. Many employers, particularly large companies, find that it is essential to offer current and prospective employees competitive group coverage in order to attract and retain good employees. Many job seekers will not consider a prospective employer unless the employer offers an attractive employment package including salary, vacation days, a pension plan, and group insurance benefits. From the employee's perspective, obtaining insurance coverage from the employer's group is a simple, convenient, and cost-effective way to build a base for their risk management program. 2.3.1.2 Association. Association groups are comprised of individuals who have characteristics in common, but who do not work for the same employer. However, the association may consist of individuals who have employers in common. The association may be formed by several employers in the same industry, such as the automotive industry, or by franchise owners of the same franchise organization, such as a donut shop franchise. The plan members are the employees of these employers or franchise owners. The members are able to access the many advantages of participating in an employer/employee group, such as the cost efficiencies that come from volume discounts on coverage. A second type of association group brings together individuals who do not have employers in common. Often the members participate in the same profession, as in the case of the Canadian Bar Association Group Plan, or the Canadian Medical Association Group Plan. Or the plan members have past associations in common, such as being alumni of the University of Toronto. For this type of association, membership in the group plan is solicited by the plan administrator, and the potential members are free to join or not join as they wish. There is no requirement that a certain percentage of the group must participate in the plan. Benefits are similar to those offered by other group plans. The plan members are responsible for paying 100% of the insurance premium, usually by direct bank debit. 2.3.2 Types of Group Disability Insurance (DI) Policies. Group disability coverage is usually divided into two distinct categories, each of which may have different definitions of disability, different benefit levels, and different waiting and benefit periods: short-term disability and long-term disability. Also, there is usually a different set of rules applicable to those group members who experience disability while on a leave of absence. 2.3.2.1 Short-term disability, STD. Short-term disability, STD, coverage, also sometimes called weekly indemnity, is designed to provide benefits for disabilities of short duration, usually less than 1 year. It also typically provides one level of benefit for the early stages of a long-term or a permanent disability, to be replaced after 1 year by the long-term coverage. STD benefits are based on a percentage of salary. Because plans are usually designed such that the employer pays 100% of the premiums for the STD coverage and benefits are taxable income, the percentage of salary is usually higher than that used for long-term disability benefits. STD benefits are likely to be in the range of 70 to 75% of pre-disability income. The definition of disability for STD coverage is generally own occupation, the inability of the insured to perform the duties of his regular occupation. Benefits often start after a 7-day waiting period in the case of disabilities arising from illness, and on the first day for disabilities arising from an accident. In either case, the maximum benefit is almost always 12 months. Some plans insuring lower-paid workers stagger their waiting and benefit periods to coordinate benefits with employment insurance (EI) benefits. EI has a maximum 15-week benefit period after a waiting period of 1 week, but EI is a second payer to many other forms of disability coverage, including group plans. Plans designed to coordinate with EI and avoid the dollar-for-dollar offset of EI benefits will pay a first-day benefit for 1 week, then no benefits for the next 15 weeks, resuming benefits starting at the beginning of week 17, at the end of the EI benefit period. 2.3.2.2 Long-Term Disability, LTD. Long-term disability, LTD, coverage takes over when benefits under the short-term disability coverage expire with the plan member still being disabled. The waiting period for the LTD coverage is, in effect, the benefit period for the STD coverage. The LTD monthly benefits are generally lower than those paid under STD, typically between 50 and 60% of previous income, compared to 70 to 75% for STD, and are generally payable for a period of 2 years, 5 years or 10 years, or to age 65. Short-term disability benefits are mostly taxable, while long-term disability benefits are non-taxable. The benefits are usually based on an own occupation definition of disability for the first 12 months of LTD, changing to an any occupation definition thereafter. 2.3.2.3 Disability during a leave of absence. There is a wide variance of coverage and restrictions that are applicable if a group plan member becomes disabled while on a leave of absence. 16 Leaves may be granted on compassionate grounds, to permit an employee to care for an ailing family member, for example. Or a leave may be granted to permit an employee to do independent research, or just to permit a break from work routine. In some jurisdictions, for example, teachers are permitted to work for 4 years receiving 80% of salary, and then take the 5th year as a leave of absence, sabbatical, still receiving 80% of regular salary during the leave. Various Group DI plans handle disabilities during a leave of absence differently. Some offer no coverage during a leave. Others will provide coverage but only if the group premiums are still being paid monthly, either by the employer or directly by the employee. Often even under an employer pay-all plan, disability premiums coming due during a leave of absence will be the responsibility of the employee alone. Some plans do not pay benefits during an unpaid leave of absence since the plan member has no income to lose to the disability. There are no hard and fast general rules. One must look to the details of the master contract to determine which benefits are, or are not, applicable. 2.3.3 Plan enrollment and membership. Member enrollment and maintenance of member records are the responsibility of the group administrator. However, the function goes beyond mere enrollment and claims administration, and involves record keeping and reporting to the insurer both before a new member qualifies for benefits and after the member leaves the group plan. 16. A leave of absence is a period of time away from work for any purpose sanctioned by the employer. Leaves may be paid or unpaid. 2.3.3.1 Qualification period. Most Group DI plans require a new employee to undergo a qualification period before they can join the group plan. Not to be confused with the waiting period for disability benefits, the qualification period is a set number of days that must expire between the date of employment and the date that the employee qualifies to join the group plan. Often the qualification period is tied to the probationary period for employment, that period of 30 to 90 days when a new employee may be terminated without recourse. In part, the qualification period relieves both the employer and the group plan administrator from having to enroll and then terminate from the group plan an employee who does not stay with the employer beyond the probationary period. 2.3.3.2 Premium payment. In the case of non-participating 17 employer/employee Group DI plans, the premium process is straightforward. The employer makes one payment to the insurance company each month, representing premiums on behalf of all of the group members. Premium payment for large participating Group DI plans, where a portion of the premium is paid by the employees and is non-deductible for them, could be more complex. If the individual plan members were to pay their portion of the monthly premiums directly, the insurance company might have to deal with hundreds or thousands of individual payments. For this reason, most insurers insist that the employer collect the employee's portion of the premiums from each plan member monthly, via payroll deduction, and remit a single payment representing both the employer and the employee portions of the monthly group premium. In the case of association or union-sponsored group plans, each member usually pays his own premium monthly, via direct debit from his bank account. 2.3.3.3 Terminating membership. A plan member could find his participation in the Group DI plan terminated for any one of a number of reasons. Black small square The master contract itself might be terminated at the initiation of either the employer or the insurance company. Black small square The member might cease to be an employee of the sponsoring employer. Black small square The member might cease to meet the definition for membership in the class of the covered group. For example, his weekly employment hours might be reduced below the minimum requirement for group plan membership. Black small square The employee/group plan member might retire. 17. In a non-participating or non-par plan, the employer pays all of the premiums for the coverage. The employee/plan member makes no financial contribution. In circumstances where the plan member no longer qualifies for membership, he may have the option to convert his group coverage to an individual DI policy with the issuer of the master plan, without necessarily having to provide medical evidence of insurability. The conversion must then be made within 30 days of termination of participation in the group plan, and is usually subject to some restrictions as to the type of policy to which the group coverage may be converted. 2.3.4 Amount of benefit. The amount of disability benefit available to group disability insurance DI plan members is subject to restriction on several different levels. Black small square A non-evidence maximum amount, without medical evidence, that is absolute, spelled out in the master contract, regardless of the plan member's qualifying income. Black small square A maximum overall amount based on a percentage of the group member's qualifying income, with medical evidence. Black small square An all-source maximum that is governed by group offset rules set out in the master contract. Diagram 2.4 illustrates the relationship between the various types of benefit amounts. Diagram 2.4 Group disability insurance benefit amounts. 2.3.4.1 Non-evidence maximum, without medical evidence, to ensure all group members can receive some benefit regardless of their health. Most group DI plans offer a basic amount of coverage for which medical underwriting is not required. This is the non-evidence maximum, without medical evidence, and it is set by considering the costs to the plan sponsor and the claim risk to the insurer. 2.3.4.2 Overall maximum with medical evidence. Recognizing that some plan members may wish to obtain a higher level of coverage, group plans may permit plan members to apply for additional coverage over and above the basic amount, which is the amount not requiring medical evidence. This additional coverage is restricted to the amount individual members can qualify for financially. It is also subject to medical underwriting, and the premiums are borne solely by the plan member. The overall maximum monthly benefit that a plan member may receive, with or without medical evidence, is spelled out in the master group plan. Larger groups typically offer larger maximum monthly benefits, often in the $10,000 to $15,000 range, while smaller groups may be restricted to a maximum benefit of $2,500 a month. A given plan member will have his coverage maximum determined by a percentage of his income, or the group plan maximum, whichever is less. The percentage of earnings that will be considered in setting the overall maximum coverage will, in part, depend on whether benefits will be treated as taxable income or will be non-taxable. STD benefits are typically in the higher percentage range, 70 to 75% of pre-disability income, allowing for the fact that STD benefits are normally taxable. LTD benefits, which are usually structured to be tax-free, are typically based on a lower percentage of salary, in the 60 to 66.66% range. As stated earlier, if members elect the maximum coverage available, the difference between the overall maximum and the non-evidence maximum amount of coverage is subject to both financial and medical underwriting. The employer or the employee has the possibility of electing coverage that is less than the maximum set out in the master contract. 2.3.4.3 All-source maximum, also sometimes called group offset amendment. The reason that DI plans, whether group or individual, set benefit maximums somewhere below 75% of the insured's regular income is to provide a disabled insured with an incentive to return to work. The same rationale applies when looking at the maximum benefits available from all disability income sources, the all-source maximum. The group offset amendment found in virtually every group master contract specifies the maximum amount of coverage permitted from all sources. These benefit sources can be classified as being direct or indirect. Direct sources are disability plans that pay monetary benefits directly to the disabled plan member, such as the Canada Pension Plan, CPP, Employment Insurance, EI, or the Workers' Safety Boards. Indirect sources are benefits paid to or for the benefit of dependent spouses or children of the disabled life insured. Such benefits could come from sources such as the CPP. 18. Benefits arising from personally owned DI policies are usually exempt from the all-source maximum rules, but these plans may have their own offset rules set out in the contract. The offsets in group master contracts usually state that benefits from all specified sources cannot exceed 85% of the plan member's pre-disability income. If the total benefits available exceed this level, then the group benefits paid will be reduced, offset, to bring the overall benefits paid back down to the 85% maximum. 2.3. For denial of benefits. Benefits from group DI plans can be denied for the same reasons as benefits from individual plans addressed earlier. In addition, benefits from group plans would not be paid if the member had ceased to be a member of the group. 2.3.5 Taxation of group disability insurance benefits. In the case of employer/employee group DI plans, STD coverage is usually fully paid for by the employer and benefits received by the employee are treated as taxable income. That is why short-term benefits are typically a larger percentage of pre-disability income, often in the 70 to 75% range. Premiums paid by the employer for the STD coverage are a deductible business expense for the employer. In the case of LTD coverage, which often pays about 60% of pre-disability income, if the premiums are paid by the employer, the benefits received by the employee will be taxable income. As with STD, the employer-paid premiums are a deductible expense for the employer. However, if the employee/plan member pays 100% of the premium, it is non-deductible for the employee, and the benefits are non-taxable. The plan is taxed in the same way as a personally owned DI policy. For this reason, most LTD coverage found in contributory group insurance plans is structured such that the employee pays 100% of the premium for the LTD coverage. In circumstances where both the employer and the employee contribute to the premiums for LTD coverage, an anomaly occurs. The employee's benefits, if any, are assumed to be a tax-free refund of premium up to the amount of aggregate premium paid by the employee since his last claim. Any benefits received in excess of that amount are treated as a taxable benefit in the hands of the employee. 2.3.6 Integrating a group policy with an individual policy. Clients may rely on either group insurance or individual insurance to meet their financial protection needs in the event of disability, or may employ both options, using an individual policy to fill any potential gaps or shortfalls in their group program. The following is a brief discussion of 2 ways the types of plan can be integrated to meet all of the client's disability protection needs. Benefit amount. Group disability insurance, DI, plans will usually restrict coverage to a maximum of no more than 60 to 66.66% of income in the case of LTD, and 70 to 75% of income for STD. Plan members who might wish a higher level of benefit could supplement their group coverage by purchasing an individual DI plan with the same waiting and benefit periods as the group plan, but with benefits that would fill the gap. Does not exceed the 85% all-source maximum laid out in either, or both, contracts. Otherwise, offsets might void some of the advantage of the extra coverage, leaving the client paying for coverage from which he could never benefit. Claims are filed against the group policy first, as first payer, and then against the personally owned plan, where there is an overlap in coverage. Benefit period. A plan member might also want a disability benefit that extends beyond the coverage provided by the group plan. This can be done by purchasing an individual plan with the same level of benefits and definition of disability as the group policy, but with a benefit period that begins when the group insurance benefit period ends, provided it does not go beyond age 65. The waiting period of the individual policy would be tied to the benefit period under the group coverage. 2. For creditor disability insurance and other providers. There is another classification of a group association not yet examined: creditors of the same financial institution. Lenders, banks, credit unions and other lending institutions, via mortgages, personal or secured lines of credit and credit cards, will often partner with a life insurance company to offer disability insurance (DI) coverage to ensure that regularly scheduled payments on the debt are made even during a period when the debtor is disabled and unable to earn an income. Creditor disability insurance is offered as a package deal with the loan itself on an optional basis. Depending on the size of the debt being insured, the coverage may be offered with little or no medical underwriting at time of application, although the insured may be underwritten at time of claim, retroactively. There will invariably be a waiting period, often 60 days, and the policy premiums are blended in with the monthly loan payment and debited to the same account that provides the loan payment. The definition of disability qualifying the insured for benefits is invariably total disability, the inability to earn income due to illness or injury. Invariably total disability, the inability to earn income due to illness or injury. 2.4.1 Amount of benefit. The benefits available under group creditor disability insurance for a loan are tied to the monthly loan payment, including principal and interest. For example, the benefits may take the form of a monthly repayment percentage equal to 3% of the outstanding principal amount, up to a maximum monthly benefit, and a maximum repayment limit. 2.4.2 Taxation of creditor disability insurance benefits. The tax treatment of group creditor DI premiums is simple and straightforward, mimicking the treatment of individual disability insurance. Black small square premiums paid are a personal, non-deductible expense, unless the purpose of the loan in question was to earn income from business or property, i.e., a business or investment loan. Black small square benefits are received, paid to the creditor on behalf of the debtor, tax-free. 2.5 How they compare. There are similarities, differences, strengths and weaknesses to the three common sources of disability protection: individual, group and creditor insurance. Table 2.4 briefly summarizes, compares and contrasts these characteristics. Chapter 3: Insurance to protect assets. Competency component. Black small square analyze the available products that meet the client's needs. Competency subcomponents. Black small square analyze the types of contracts that meet the client's needs. Black small square analyze the riders that meet the client's needs. Accident and sickness insurance. Chapter 3: Insurance to protect assets. 58.